Welcome and thank you for attending this exclusive webinar. And for those that I haven't met, my name is James Lowe, and I lead the Morningstar team that strategically partners with advisors and practices and licensees to really provide our solutions and services in a manner that not only aligns to best practices that we see from advice businesses across the globe, but importantly for what is unique and makes sense for your firm and advice process. I know the team are absolutely delighted you can be here as we progress our 2021 webinar series for modern advice businesses who are really looking to implement best practices. Firstly, a big thank you to all of you on the positive feedback we've received over the last few months on the Modern Advisor series of webinars, where we've really focused on best practices and topical themes that are really relevant for you as you see your clients. Never more so than the webinar last month from my colleague Peter Burns on the alignment of goals-based advice and investment solutions, which had a record attendance from advisors. So we're really happy you found that as valuable as you did and relevant to your practice. For those that haven't watched it yet, please do contact us. We'll be glad to send you a recording to look at it in your own time. I think similar to last webinar, today is a great follow-up as it truly integrates the three pillars of our strategic partnership service we provide to advice practices. And those three pillars are investment solutions, secondly, behavioral coaching, and thirdly, practice optimization. So before I do an introduction, I thought I'd just touch on a few housekeeping items. Firstly, there are CPD points for today, and you will get that after the forum. We'll get them emailed through to you. Secondly, in terms of questions, there is a Q&A there. We do encourage you to please send through questions there. We will cover a lot of those in the session. Try use the Q&A rather than the chat, but irrespective, we'll most certainly address them. In terms of a disclaimer, everything you're going to be hearing today is of a general nature and does not take account of anyone's personal circumstances. Right, so in terms of introduction, as I said, today really covers all three pillars, and I thought it was important to provide a practical overview of how this occurs and what you're going to be hearing. Now, you would know when you deliver goals-based advice to your clients, there's the lifelong cash flow modeling with bucketing methodologies that you would implement, values-based planning, understanding what's important about money to your clients, and really their goals, needs, and aspirations. Having gone through that, it's really about the quality financial strategy that you implement to achieve those goals. And that quality financial strategy is then provided to external appointed specialists, that would be tax, lawyers, wealth protection, etc. But a really crucial aspect of that financial plan is the investment strategy, which is then implemented by a professional manager for your client to achieve their goals, needs, and aspirations. Now, in developing and implementing this investment strategy, there are key aspects. Any reputable analysis will show that the best practice for any advice business that you see around the globe is that their investment approach is repeatable, it's evidence-based, and the investment philosophy and approach is really made with decisions of their clients at the center of it. It is a gateway for all successful advice businesses. Now, in last session, Peter really covered this in detail, and that is really our Morningstar thought leadership and insights on an evidence-based investment approach that advice practices can utilize that has your clients at the center of every decision that is made on those portfolios to achieve their goals. Behaviorally, it's also designed to help your clients stick to their quality strategy. And then thirdly, as joint fiduciaries on your clients' assets, there can be no better way to demonstrate you're really acting in their best interests. Now, today's session is a really important follow-up to that because it's really when the rubber hits the road. So the approach we've taken for today is treated as a client-simulated experience of how this best practice approach is used on the key themes that are impacting your clients. So firstly, what are the 2-3 key themes that have impacted the wealth of your clients and what returns they've probably received in the past and looking ahead? More than likely, they've done okay and done pretty well, but let's just discuss that. From a joint fiduciary perspective, based on that evidence, we can then look at those themes going forward and how you look at your recommendations from a reasonable basis perspective to best position your clients' investment solutions. So enter Clint Abraham. Clint is the director, investment specialist, a part of our team that is dedicated to working with advice practices who are looking to transition their businesses to goals-based investment strategy. Clint works alongside the advice solutions team to implement the investment pillar of that service offering I mentioned earlier, and has significant practice in working with portfolio managers running goals-based investment solutions. At a personal level, having worked with Clint for a number of years now, there are very few people I've come across who are able to position valuation-driven asset allocation and global best practice investment approach that Morningstar implements better. And that was really founded in Australia and is now done globally. So with that, I'll hand over to Clint, who will go through the presentation.
Thank you, James. Good afternoon, everyone. Thank you for joining the session. I very much look forward to sharing Morningstar's insight with you and talking a little bit about how we see the investment environment at the moment. Now, of course, we're going to talk about the opportunities that we see looking forward. But before I talk about that, I wanted to, I guess, set the scene by having a discussion around where we've been and what has influenced the returns up until this point. So, if we think about what has influenced your client returns over the last, let's say 2021, or even since the lows that we saw in the COVID sell-off from at the end of March 2020, it really has been an extraordinary period of gains. So what this chart is looking at are the returns for key indices year to date. And what we can see there, if we look at those key regions in terms of the USA, Europe, the UK, and Japan, it's been a very strong period for global share markets. Australia is not on this chart, but if I was to include it, it would also show a very strong positive green bar to the right-hand side there. Now, this is very much indicative of, I guess, the improving sentiment that we've seen from those COVID lows. If I was to extend this period back to the end of March 2020, what you would see is a period of phenomenal gains. So COVID uncertainty, when COVID first became declared a global pandemic in February 2020, we saw a very significant sell-off in share markets, and that was anywhere between 30 and 35%. But what we've seen there, as I touched on, is this exceptional rally. It was the fastest fall of that magnitude that we've ever had, and it's certainly been the fastest recovery. In most cases, in fact, share markets have not only recovered those COVID losses, but they've gone on to make very significant highs. And as we can see here at a country level, yes, there's some differences, when you get down to it between the returns, but generally speaking, it's been a very strong period across the board. The USA, if I was to go back to that post-COVID period, was very much the strongest performing region. But as you can see, the others have done quite well throughout that period as well. The exception that you can note on there is what's happening in the emerging market space. And this really comes down to what's happening in China. And you may have seen some headlines about this recently. So the Chinese regulator is very much seeking to make a more competitive environment for companies, and that's focused on Chinese big tech in particular, but increasingly it's moving into other industries as well. So this has created quite a bit of uncertainty in the Chinese market. The Chinese market alone was down around 14% in the month of July, and since that time we've had a bit of additional uncertainty as Chinese property, the second largest Chinese property developer, Evergrande, has it's debt riddled, and there's concerns around its long-term viability. And so that has weighed a little bit on the sentiment to China and by extension, Asian and emerging markets. But as I said, outside of that, more broadly, this has been a very strong period. As we come down this chart, we can see references to value and growth. We're going to talk a little bit about that in more detail as we move through the presentation. As you can see, value has outperformed calendar year to date. And of course, small caps have outperformed large. Now, this is very consistent with what you might expect during an earnings recovery, where the longer term outlook is much more positive. The outlook for economic growth, as you'd be aware, is much more positive as we've emerged from the lockdowns of COVID. It hasn't been plain sailing across all asset classes, though. The ones on the bottom left-hand side of this chart, they refer to fixed income assets. And the one to take note of there is the first one, which is the global benchmark for bonds. It has actually delivered a negative return. And if I was to put the Australian equivalent on here as well, that would have also delivered a negative return. Now, as you're probably aware, all things being equal, as bond prices rise, interest rates fall, and vice versa. And what we've seen more recently is an uptick in interest rates. And the reason behind that has a lot to do with this economic growth that we have experienced since the COVID lows in March 2020. As economies begin to grow, it's normal to expect inflation to follow. And that's certainly front of mind for investors at the moment, where we saw this earlier in the year as well, given that the level of growth, people are starting to see prices rise. Now, we would say that that's perfectly normal to expect in an environment of an economic recovery. And while ever inflation is at reasonably moderate levels, there's nothing in that alone to be worried about from an investing point of view. We think it's unlikely that we're going to see high inflation or higher inflation or hyperinflation. So for the moment, moderate level of inflation is what we think will be reasonably maintained. Now, why that's important is that the way that central banks primarily control inflation is through rising interest rates. And so we've seen interest rates rise pretty sharply over the course of this 18-month period, and particularly throughout the month of September. So as you may be aware, September was a weaker month for share markets generally. A lot of that had to do with rising inflation, rising interest rate expectations. Even right now, the Australian 10-year bond yield is up around about 1.7%, having been as low as 1.2% recently. And so that's feeding through into softer bond returns. Now, that's quite exceptional, because we've had this period where interest rates have trended lower for a long period of time, and bond prices have risen, so bond markets have done fairly well. But more recently, as you can see there's that point of weakness. Now, when we cut and dice this a different way, we can have a look at the sector returns from global share markets. So again, this is year-to-date data, and the little green diamond at the top is the peak of that particular sector's return, and the red cross is the trough of that return over the period. And what we can see here is it's been, again, a very strong period of performance, but this is really where this idea of divergent returns comes through, and it didn't really come through on the preceding slide, because this calendar year to date, the bulk of share markets have done well. Yes, some have done a bit better than others, but generally speaking, it's been a very strong period. But if I was to go back and pick that up from the start of the recovery from the COVID sell-off, what you would see is a very divergent path to returns. And there were times when some countries were doing much better than others. This is really shining through here on this chart. What we can see is energy has been very, very strong, and financials. And for those of you that know our portfolio positioning, this has actually proved very, very positive for portfolio returns. And a lot of this has to come, the reason behind the improving sentiment behind energy and financials has to do with people's confidence that economies are starting to open up. People are going to get back to some version of what they perceive to be normal, and that means we can travel again and we can consume the way that we once did. And from an investment point of view, that means that there's going to be increasing demand for energy, and we're actually seeing this at the moment. So there appears to be an energy crunch that's underway. There's a natural gas shortage in Europe at the moment, which you may have seen in the headlines more recently, and also increasing coal demand through China primarily. So if we look at the oil price at the moment, it's in excess of $80 a barrel. It's a 3-year high, and that is flowing through into much more positive sentiment toward that sector. So when we look at the companies in that sector, we're thinking of the big oil and gas names, BP, Shell, etc. They are very well positioned to benefit from that rising oil price and that improving investor sentiment. Now, again, as you may recall, we actually bought those assets in the time of greatest uncertainty, which was when COVID first occurred and became, as I said, a global pandemic. And the reason that we bought at that time is that those assets became very unloved. People didn't give much hope to the outlook for global growth. In actual fact, people were concerned about a deflationary scenario for periods at certain times during that period. And so those prices were quite depressed. As we can see now, vaccination rates are soaring, economies are beginning to open up, and now people are feeling much more comfortable to invest in those sectors once again. And as I said, we've actually seen an energy shortage, which is increasing the demand for certain commodities at this point. Now, when we're having a look at share market returns, we can dig a little bit deeper to understand what has been really driving returns throughout a particular period. So there's quite a bit going on in this chart, and I'm just going to explain some terminology first before we have a look at what this chart is actually telling us. So what this is looking looking at, as we know, the MSCI World is the global benchmark for share markets. It's made up roughly around about 60% the US, and then we look at those other big countries, Japan, Europe, and regions, Europe, the UK, etc., and they're based off the market cap. Now, over time, and this is a very long chart, a 40-year chart or so, the market will have gone higher or lower, and you might be able to identify some of these key dates like 2008 and so forth as being, you'll remember that they're very significant times in financial history in terms of the global financial crisis or the tech boom and bust if we go back to the turn of the millennium. What this chart is looking at is how two factors only, two dimensions, have contributed to returns over that period. So on one hand, we're looking at value. And so this looks at things like price to book, price to earnings, price to dividend, or otherwise known as dividend yield. And then the second one there is looking at growth. So when we look at short and long-term earnings growth, the trends in earnings, the trends in sales growth and the like, and it's categorizing according to those two frameworks. Now, what we can see here is there are times when value does well, there are times when growth does well, and what we can see from this chart is that they generally mean revert over time. As it relates to value, value is particularly prominent when we go into an economic recovery. So again, we can touch on these points, and again, I made the point that this coincides with the lows of the GFC, the lows of the taper tantrum, and of course the lows of the COVID sell-off. That is the time to buy those value opportunities historically. And as you can see, they've enjoyed a very strong period as we've moved into an economic recovery that's followed. The point to note here, this is looking at charts in a 1 year sense. This value, the divergence between value and growth in the COVID sell-off was the greatest that we've seen. Simply extraordinary. And again, to think about what COVID brought to investment markets, it was very much an external shock, a very short, sharp and significant sell-off, and people did not give hope to those value companies. And those sectors that I touched on, energy and financials, they're very prominent in that value lens. What they were happy to do was pay up for earnings growth. And much of that earnings growth came from the so-called FANGs, which is Facebook, Amazon, Apple, Netflix, Google, and I can put Microsoft in that group as well, where those earnings actually held up relatively well because we were working from home, we're increasing our consumption of their products and services. Perhaps we're ordering more online using Amazon or consuming Netflix, bringing forward consumption, if I could say it that way. And so their earnings actually did quite well in that period, and people were happy to pay for that. What we can see, though, is that as this has turned and the world has gone into an economic recovery, a lot to do, with a lot of confidence coinciding with the increasing rate of vaccination, we can just see how quickly this has snapped back. And you'll see that people feel much more comfortable now investing in these value sectors, like we touched on financials and energy there. But the time, of course, is to invest when you have that greatest dispersion. So on a 1 year view, this is snapped back. And again, you'll remember those slides that I showed a little bit earlier that had financials and energy very much prominent for year-to-date returns. But when we consider this in a longer term context, you can see that this trend is just shifting now. It's just turning. And so exactly the same data format, but it's looking at a 3 year view. Again, it's still, there's an element of mean reversion here. We can see that when they diverge, they tend to come back. This point here, of course, coincides with the lows of the COVID sell-off just here, but we can see this slight turning now as people become more favorable towards the outlook for value. Even so, at this point here, it is still the widest it has ever been. Such has been that dislocation, if you like, that divergence between growth and value. Even after the more recent positive view towards those value sectors, you can see why we believe there's still much more to go in these assets. And of course, when we're buying these assets here as we were when we consider energy, which is, as you may be aware, is a significant part of our portfolio. We're buying them at depressed prices, and so when we start to see assets rallying like they are now, that gives us the opportunity to really lock in some significant gains over the longer term for clients. Now, I should make the distinction here that we're talking about value and growth, and we are valuation-driven managers. So that doesn't mean that we won't buy growth assets. We will. We just want to make sure that we're getting an appropriate price for them. So what this chart is showing at is how our portfolio position to the value factor has changed over time. And what we can see here as we come into this period of COVID uncertainty here, we have really lent into that value. This is where we could identify very strong, the potential for very strong gains. And a lot of this comes back to thinking a bit like how Warren Buffett might say this, which is, when you're investing, you need to be greedy when others are fearful, and fearful when they're greedy. And the energy sector throughout this period here fell the best part of 60% in less than 10 weeks. And the financial sector was down around 45% at its lows. And so you can see here the opportunity for us to buy these very high quality businesses at pretty depressed prices. And this is what the evidence of us moving into those positions. Again, we're not averse to buying growth assets. We just want to make sure that we're getting, that we're not having to pay overs for them, that we're still getting them at an appealing price. And of course, while we're talking about value here at the moment, in a general sense, what I haven't mentioned is, I guess, the qualitative side of the analysis that must go with that. So understanding the quality of the cash flows. Are they robust? Are they sustainable? Would we expect those cash flows to grow over time? Or are these assets cheap for a reason? So in actual practice, we get quite a bit deeper than just that simple value versus growth, really to understand the key drivers of returns for the assets that we want to purchase. And a final point on that growth, the growth versus value factors. More recently, some of you may be aware if you've been following our portfolio positioning, but more recently we've initiated an investment in Chinese big tech, Chinese shares, because we've seen, as I touched on before, the influence of the Chinese regulator, particularly on big tech, and we've seen a lot of weakness in that market. But then when you have a look at the companies in that space, the likes of Alibaba, Tencent, and so forth, these are very high quality businesses. They're what we would refer to as wide moat rated, because of the sustainability of their profitability. And so that uncertainty in that market has created an opportunity for us to buy those growth companies at a really appealing price.
Clint, just one,
Sure, James.
and I've had a question come through independently on
Sure.
on this, and you made the comment a little earlier about, and we might be worthwhile just clarifying what you mean by it, which is you need to buy into these opportunities when they occur and before they happen, and it's too late to, or too hard to buy them and sort of after the fact, so to speak. And
Yes.
and I know you've sort of touched on that with the positions that were taken when the evidence suggested that back in sort of last year, particularly in energy and financials. It might be worthwhile just clarifying a little bit more detail on that, because the question has come through on that, just to, like, what does that mean?
About getting positioned before the event?
Yeah, position before, and really following that evidence-based approach in terms of valuation.
Yes, of course. That is a good question. So typically with our investment approach, what we're looking to do is buy attractively priced assets, and we don't want to pay full price for them. We want to get them on sale, because everyone likes a bargain, of course, and we're trying to do that with the financial assets that we're looking to pick up for our clients. The thing is, though, that the opportunity to buy good quality assets at a good price typically only comes when there's great uncertainty around some sort of a headwind, and this is both at a stock level or at an overall market level. COVID, for example, created great uncertainty around what the longer term profitability, distributions, etc. for companies might have been, and as a result, we saw very significant sell-offs in that period. What we're really interested in doing is that we can understand the headwind, we can acknowledge that, but we're constantly looking to understand what's in the price. And when we apply that analysis again throughout that COVID period, we could find a whole range of assets, as you can see on this chart here, really leaning into some of these value opportunities in energy and financials that were attractively priced, that do have very robust business models and strong long-term cash flows, even in view of everything that's going on. And as I said, at that time, nobody else liked them. And so what we find is that time and time again, human emotion in times of uncertainty, it leads investors to overreact. So COVID is this very uncertain period. Investors are more likely to sell rather than stick around and find out what that looks like. And in doing so, they sell at any price and then lose track of what the actual asset is worth. So they sell at a price well below what it's fundamentally worth. And again, to pick up on Buffett's saying about being greedy when others are fearful and fearful when they're greedy, that is absolutely an opportunity for us to act. And we did act, absolutely, thankfully, because we were able to pick up some bargains at that time. Picking up things, and again, if you cast your mind back to that period, share markets in particular were enormously volatile. There were regularly moves of 5% one way or the other, up or down. It didn't make a lot of sense which way it was going from day to day. That's very consistent with what happens in that stage of a sell-off. And what happens is that good things get thrown out with bad things. The whole lot, the bathwater, everything goes out. And so our opportunity is to work through that, to identify those quality companies that have just been caught up in the selling, where we can actually buy these assets that will deliver over the long term, and we don't have to pay too much to buy them, and we get them for much less than they're actually worth. So one of the reasons that we, and you touched on this in your opening address there, James, about this being a robust process, is that it is robust, and we also think it's repeatable, because the actions of investors, because we're all human, they tend to be surprisingly predictable, which is in times of uncertainty, people panic. They don't like that uncertain and anxious feeling, and they can tend to sell assets for much less than they're actually worth.
Yeah, thanks for clarifying. I think the thing that sort of jumped out at me as you went through the previous slide and this one is really the value and growth dislocation, as you said, is still the biggest in history.
Yes.
And because these opportunities have been taken back last year, where you got the circle there, is when it turns, it's going to turn quickly, and we don't know when that'll be. But at least it goes back to those opportunities were taken before the turn. I think that's really important, and the value can be extracted.
Yeah, and that's really the point, because in buying in that uncertainty, there will be a time where you get more clarity, you get more information, those headwinds tend to dissipate. Now, the big catalyst for share markets was, of course, confirmation that we were going to have, that the vaccine had come to fruition and would be an imminent rollout. Suddenly, people then realized, actually, there might be a chance that we can get back to our normal lives. And if that's the case, then we're going to feel much more comfortable to invest in some of these more cyclical, economically sensitive assets. And then that's when you start to see the price rise. Now, of course, that we're in at a price that's below when people didn't really have that level of conviction. Okay, so let's take a look at another way that we can have a look at what's been driving share markets over this period. Now, what this chart is looking at is the return from the COVID lows in 2020, so the end of March 2020 through until July this year. And as I said, it's been an exceptional period for share markets over that time. We can see the little blue dot in the middle of these bars as the net return throughout that period. But what we can do is that we can actually deconstruct these returns and understand what's really been driving that outcome. So if I take Australia, for example, what we can see there is there's a dividend yield at the top here. Let's call that 5%. But interestingly, earnings growth was actually negative for Australia, and quite significantly so. Now, that makes sense. We've been in lockdown, and in some parts of the country, we're still in lockdown. So it makes sense that we would see earnings, EPS losses here. But this blue bit here is price earnings multiple expansion. So what that means is, if we think about the PE ratio, so price on the top, earnings on the bottom, people are prepared to pay more for shares now in expectation that you see earnings coming through in the future. Now, this is not uncommon. It's very typical to see this in the early stages of an economic recovery, because share market investors are a forward-looking bunch. They're valuing assets 2, 3, 4, 5 years out, what cash flows are going to come through. And so when you have an economic recovery, people are obviously much more confident about the future profitability of companies, and they move very quickly to price that in. So that idea in itself is not new. It's actually very common, but the magnitude of this or the willingness to pay more in this situation has been simply extraordinary. We can see that it's actually consistent across most global share regions. We've got the world in the middle here as the aggregate of all of those. So generally speaking, earnings growth has been fairly limited, if any. In the US, there has been a little bit, and that's been heavily driven by the FANGs plus Microsoft, as I touched on before, which did do reasonably well throughout that initial part of COVID lockdown. But in an aggregate level, earnings per share actually negative. And of course, we've got the currency effect there. However, that price, the price multiple expansion is consistent, generally speaking, across those key regions. This is actually an environment that passive does very well. So if I just had an index exposure for global shares, what we can see here is that people tend to be happy to pay higher price right now for future earnings. That tends to happen across the board. And so index investing is particularly well positioned for this. Obviously, they're biased towards the biggest companies. Those biggest companies are the ones that stand to benefit the most from multiple expansion. It's a bit like the analogy of the rising tide lifts all boats. And we can see that again and again. The magnitude of it in this particular situation has been very extreme. Now, why that is important is that if we think forward, what we would expect in the next stage of this economic recovery is that we start to see actual earnings coming through. So people have paid up now for earnings that they think are going to come through into the future. If those earnings don't come through, then what people are left with is just a very expensive asset. And so this is the environment, firstly, where there could be much higher volatility, much higher risk of loss. If those earnings don't come through, those assets that do not meet those expectations could reasonably be expected to be harshly dealt with. And the second thing is, this is an environment that active management typically prospers. And again, this comes down to getting a little bit deeper, understanding the quality of the cash flows and the earnings of different companies, different sectors, different countries and regions, and being in a position where you can position your portfolio accordingly. So when we're talking about this being a very significant impact, it has been. And what this chart is looking at is forward PE ratios, so the price looking at forward earnings. What we can see is comparing the US to the developed world and emerging markets. And there's a couple of things to take away here. Firstly is that the US and developed world, if you look back in history, they've generally tracked close enough together. There's been times where one has outperformed the other and vice versa. But if you look at this most recent period, US PEs have just gapped developed markets by a level that if you look back there, you can't really see too many periods where that's happened before. The second thing to look at is just look at how high these numbers are in an absolute sense. So the US is as high as we've seen for 20 years. And again, this goes back to the tech bubble, of course, back here. So this is not to say that there's a crash coming. There might be. We can never forecast that. But what we are saying here is that there is now a lot of very optimistic assumptions being priced into the US market. There is, perhaps to say, there is very little room for error should something come along and impact those earnings that the market is currently expecting to be delivered. So that raises the risk of loss. And again, from our point of view, when we're investing, we're trying to deliver an outcome for our investors, and that outcome is related to inflation. So yes, we will use share markets and bond markets to gather up our assets and put them in a portfolio. But what we're trying to deliver is that outcome that has an inflation plus objective to it. inflation plus 3.5 or whatever it might be. The reason that that's important is that means that we can effectively get our growth assets and our defensive assets from wherever we like. If we see assets that are expensive, then it makes much more sense to avoid those assets in favour of ones where we're getting a much better reward for risk. And again, if you're familiar with our portfolio positioning, you'll know that we don't have as big a weighting to the US as what you might expect, and charts like this really give that reason why. On a number of key metrics, the US looks increasingly expensive, and what happens when you have increasing expensive markets is that your expected returns are quite low, but the risk of loss, should those assets return to their fair value over time, becomes much more elevated. I'm going to talk about that in a little bit more detail when we get to some of our outlook comments.
Clint, a question has come through here, which I know you have covered, but I don't know if there's anything more you want to say about it. If you feel you've sort of, and that's really about the active passive piece, and suggesting that it's going to be it could be a pretty tough time in passive going forward. And you mentioned the ability to actually identify securities and assets where there will be earnings. Is there anything else from an active passive perspective that'd be worthwhile touching? The query talks through ETFs and most of them being index driven.
Yes, so I will come to that. I have a chart in a few slides' time that I'll talk in a little bit more detail about that. I think it's important to highlight that we are not anti-passive at all. Our heritage, as many of you would know, is very much as an asset allocation house, and so we value something like 400 markets around the world every month, and we look at countries, we look at regions, we look at sectors, and quite often the outcome of our analysis is that country is attractive and that sector is attractive. And if that's the case, then ETFs make a very cost-effective and efficient means for accessing that type of that particular market. But there are also other markets where markets are quite unattractive. The US, for example, where that's the broad market, the S&P 500, and that is going to give you, relatively low return, much more elevated risk of loss if we're right. And so in that respect, having an index investment doesn't necessarily stack up. For us to invest there, we would need to look at individual companies or sectors or whatever it might be, something that's going to give you an improved return for the given level of risk that you're taking. And the thing with index investments is they generally invest under a market cap basis. So the biggest companies are what you're buying. There's no specific consideration of valuation or indeed quality in that framework. And so we consider active versus passive as tools in your toolkit, and you choose whichever one makes sense for the opportunity that you're looking at. And for those that know the portfolio, they'll know that we have a combination of ETFs. We also use external managers or direct securities, whatever it may be, to make sense for what that portfolio is looking to achieve. The point I'm trying to make here is that we have gone through this period right now, and really, I mean, we could extend this back to 2010, where it's actually been a very positive period for share markets. The periods of loss that we have had, firstly, have not been very frequent, and secondly, have not been very severe. In fact, the COVID sell-off that we've had more recently is by far the greatest period of losses that we've had since the European financial crisis. So that's not normal, and it just does go to indicate the influence of central banks in their monetary policy and so forth. And in that environment, passive has done very well, because, as I said before, there's that sentiment around you just needed to be in. It almost didn't matter what you're in as long as you're in something, because, as I said before, the tide is lifting up all boats. If we're right, that is unlikely to continue into the future, and I'll share with you some data around that. If that's the case, that really favours having a more active approach to the assets, the asset classes that you want to invest in, and of course, when you come a layer down and you look at the underlying investments, what that looks like. So let me share with you some data around that. So now we're starting to have a look at what this might mean for portfolios and their positioning moving forward. First, I just want to take us through a little example. So let's have a look at the pie chart on the left-hand side. This is a fairly typical 70-30 portfolio. And again, we're using some APRA guidance here in terms of the asset classes that that fills out. So you can see that there's 35% in Aussie shares, 35% in international, 12 in each of Australian and international bonds, and then a weighting to cash. That would look, I would imagine for most of you, like a fairly typical SAA. If we had perhaps a bit of property and infrastructure that might account for, say, around about 10%, that would maybe take a little bit off both Aussie shares and international shares. But generally speaking, this is a fairly typical starting point for most investors. Now, what we can see on the right-hand side is how that portfolio has performed over time versus a rolling 3-year objective of inflation plus 3.5%. Now, if we look at the most right column, what we can see here is that that portfolio has achieved the rolling 3-year inflation plus 3.5% objective 96% of the time. That is simply extraordinary. The vast majority, and again, when we're looking at the underlying investments here, we're looking at passive. So that 35% Aussie shares would go into the ASX 200, and the 35% for international would go into the MSCI World and so forth. Just being in passive throughout that 10-year period has been extraordinarily lucrative. And of course, it's cost effective as well. And there are reasons why that's the case. We've talked a little bit about central bank involvement and so forth, and certainly more recently around how markets and investors typically behave when there's an economic recovery underway, and most assets do well in the early stage of that environment. But what we can see here is that when we look in the fullness of time, and we've got 4 other decades there to consider, it's not always that way. In fact, if we went back to the 2000s, which had some very significant financial history moments in there, of course, with the GFC and so forth, we can see that in that period, a standard 70-30, like you can see on the left-hand side here, it actually didn't achieve that objective on even a 40% basis. Over time, this portfolio has achieved that rolling 3-year CPI plus 3.5%, only around about 62% of the time. Now, if you think the next 10 years look like the 10 years we've just had, which is this, then that would favor active management, the existing passive structure. However, if you recognize that going forward is probably going to look different to now, then this is why we say this is perhaps a little bit misleading around what you might expect moving forward. And again, we can see in the fullness of time, we've just simply been blessed here. This has just been an extraordinary period for returns, and it's not what we would say is normal. This is much more consistent with what you might reasonably expect over time. So what does that mean? It means that this passive approach has done very well. So it's not to say that there was something done wrong there. It's actually been hugely beneficial, as you can see. But going forward, investors and advisors probably need to think about this a little bit differently. So let me take that same portfolio on the left and apply our forward-looking numbers to it. Excuse me. What we can see here is, again, if we look at those basic asset classes, we've got global shares, Australian shares, those ones, and these are our nominal expected returns. So this is just the number that we're expecting from them. These are long-term numbers, 10-year numbers. What we can see there is that for each of those asset classes, those numbers are quite low, much below what we might otherwise reasonably expect and what we might consider to be fair, much below. That's really a function of where we've been. We've just run so far in with share markets in particular, and also bond markets, that there's less left on the future for less left on the table for future investment. And as you might recall me saying before, with a lower expected return comes a much greater risk of loss. So this also suggests that you're going to see more volatility. When we aggregate that up, this is the expected nominal return for that growth portfolio. It's actually quite low, and it is nowhere near that inflation plus 3.5% objective that we were talking about, that it previously very successfully hit over the preceding decade. We don't believe that broad share markets and bond markets are going to help you to achieve your returns over time. This means you need to do something different, which means you need to actively manage the allocations and to really focus on those opportunities that are going to give you a superior reward for risk. So what does that look like? Okay, so let's break this global shares one down in particular, because this is a fairly small number and it's probably helpful to understand why we land on that particular outcome. What we're looking at here is return versus risk for a whole range of growth assets here. Now on the vertical axis is return. This is a real return, whereas the preceding slide was nominal. So this is returns after inflation. Again, long-term numbers. And then we've got the increasing risk of loss from right to left. And again, our definition of loss is the risk that we lose money that we can never make back. So it's a drawdown figure, a maximum loss. Where you want to be on this chart is in the top right-hand corner. That means that you're getting a relatively good return and the potential for risk is much more diminished. By contrast, where you don't want to be is in the left-hand corner of this chart. Because you're not getting an adequate return and you are open to a much greater risk of loss. The size of the bubbles is consistent with how big that particular market is. So what we can see here on the left is the US, it's a massive bubble. The US makes up about 60% of the global market cap. And so if you are pointing passively into that global shares market, or even under an SAA basis, if you can see your allocation to global shares, that's going to have an underlying benchmark that's around about 60% weighted to the US. As you can see here, it may well be the biggest market, but it gives us an extremely poor reward for risk. The expected return is negative and the risk of loss is significant. So again, if we knew that information, and we do, we must position our portfolios away from that broad US market exposure. Again, if we're investing in that market, we need to do something different in terms of countries and companies and sectors, and in practice we do both of those things. The other one that's worth noting there is Europe. It's a very big market as well. It's only very slightly better than the US. So we can see immediately the two key regions that we're looking at in a global sense, they're actually pretty unattractive. And so from our point of view is trying to focus on where we're going to find superior returns for clients. We need to look elsewhere. Where we can see them is over here on the right. And again, some of you may be familiar with our positioning around UK shares. UK shares saw a lot of uncertainty, firstly because of Brexit, but then with COVID, they were among the countries that were initially very significantly hit. Sentiment in that market has been poor. And funnily enough, they actually have a number of those value sectors or a significant weighting to value sectors like financials and energy that we touched on have done quite well recently, but for a period of time they were quite unloved. The UK market is quite small, as you can see in the context of some of these, but it's giving us a much superior reward for risk. And that's why our portfolios are leaning that way. And again, of course, we're talking about value, but when we actually get in and have a look at the underlying fundamentals of those companies, the UK market is a who's who of global business, very high quality names, very significant, very sustainable business models, we think. And we are getting attractively compensated, reasonably compensated to invest there. Japan's the other one from a current portfolio positioning angle. It's done quite well lately as they've changed political leadership there. That is still a key area of focus for us. Now, if we cut and dice this a different way, we can have a look at it as sectors. Exact same framework with return on the vertical axis and risk of loss increasing from right to left. What we can see is some of these common areas that have done very well, like the IT sector, which is heavily weighted towards both Apple and Microsoft, has done very well. We think there's a lot less left there now for future investment. And in actual fact, there's the increasing risk of loss in that sector. If we say that another way, we think when we take the share prices and work backwards to understand what we need to assume around earnings growth, profitability, etc., we have to make some relatively unrealistic assumptions there that are unlikely to be delivered over time. If that proves to be right, then again, there is the risk of loss in that sector. We can also look at these other sectors here. Consumer discretionary is heavily dominated by Amazon. Communication services is where Facebook and Google sit. So the same FANGs theme that we've been talking about already, with those FANGs plus Microsoft doing very well, it leads us to be more cautious on their outlook moving forward. Where we can see those opportunities over here in this top quadrant, and energy I touched on here, it's a relatively small part of the global share market. It's only around about 5%, but a high quality opportunities in that market, we think, because the underlying businesses are very strong and we're getting very attractively compensated. Even after the rally that we've seen so far, they were just depressed that much at the start. And of course, financials will be the final one I'll touch on there. Largely banks, but it also looks at insurers and asset managers. Even with the rally back in that sector, as people become more confident in the economic outlook, there's still a fairly significant opportunity there on our analysis. So James, I might pause there and just welcome any questions that you might have or that are coming through.
Yeah, thanks, Clint. I think there have been a few that have come through, but I know that you have touched on them. I think it's almost like people knew it was coming next, some of the questions that came through, but it might be worthwhile sort of going into a little bit more detail. I think one really interesting one is understanding where you spoke through how the price expansion has come and sort of earnings is coming next. There's a question regarding interest rates and cash rates, and I know you briefly touched on it, understanding the elevated P ratios, but what does this really mean when compared with interest rates? And I think we hear this quite commonly from advisors.
Yes, and there's no question that is an influence in this at the moment. So if you think about the way that share market investors invest, they're looking at future cash flows and they're discounting them back to the current day, the present day, to understand what they're worth. Now, the smaller the interest rate that you use, the higher the present value of future cash flows. And there's no question that people are using that as a justification for being prepared to pay more now. So expanding that PE multiple. But even in view of that, this move in that PE space has been very, very significant. And if we were to see, well, firstly, we're not sure that there's capacity for further PE expansion from this level. But if we were to see that, I think that would be reasonably concerning, because that would be pushing us quite into stretched territory, I think. Just on the interest rates, we've seen this. We may well be in a low interest rate environment for the foreseeable future, but I think what people are realizing is that, and central banks are articulating this at the moment, that we're likely to see higher rates, and that's starting to be priced into bond markets already. And so again, to an extent, that's been unwound a little bit as people look towards higher. Not to say that rates will be ratcheting back up, but they're probably higher than the emergency levels that we see at the moment.
Just a couple of other questions that might be worthwhile touching. One of them was sort of on energy and how this will be impacted by the targets likely to come out of Glasgow.
Yeah, so there's a couple of questions on energy there. I'll try and answer them all in one go. With there's obviously an ESG angle with energy, but what you might not realise is that some of those big oil and gas names, particularly the ones in Europe, they have very significant renewable operations underway. And if you look at their company reports, for example, you see a lot of money getting pointed into that, the ESG angle. And yes, it's different from their traditional activities. I would argue they're actually well positioned because of their distribution channels. If they are able to bring those renewables to the fore, that they are well positioned to distribute that energy. And as I said, it's very much front and center of their policy at the moment. So what we're also seeing at the moment is this looming energy crunch, and it's clear that while renewables are a very noble intention, and these companies recognise it as the way of the future, right now we're still going to be more. We're still dependent on coal. We're still dependent on oil, and so there's going to be a transition period. In terms of Glasgow specifically, we don't know what's going to come out of that yet, but I would say that those oil and gas names are very conscious of that broader ESG theme and are transitioning quite quickly. The European guys are ahead of the ahead of the US ones for the moment, but the US guys are certainly recognising the views of shareholders to move in this way as well.
One of the questions just in the last sort of couple of minutes, and sorry, just thank you to everyone for all your, we've got heaps of sort of questions coming through here, and I will close out in terms of some of the specifics on that, and the team at Service Practices will absolutely get back to you. But just from a last question perspective that has come through, I think the financial sector is an interesting one, driven by credit growth and interest rate margins or dividend. Like, what are the expected returns in that sector? What's really driving them? Is it credit growth, interest rate margins, or dividends?
Sorry, just repeat that question again,
So
sorry.
are expected returns from the financial sector driven by credit growth, stroke interest rate margins, or dividend growth?
That's a great question.
Yeah.
It's more, it's a little bit of all of that. It's more, if you take a higher level view, it's coming at it from an angle that the global economy is picking up, and so you're going to see, much more. Banks are obviously leveraged to the outlook of global economy because people are more confident to borrow and invest and whatever that may be. So that's more the angle from a profitability, as opposed to when we're in the COVID sell-off, there's great uncertainty around what the future looks like, and people just don't have that confidence to go and borrow and invest.
Perfect. Look, Clint, I know we're at the top of the hour, but there's a bit I want to sort of close out with, but just a big thank you. I think I think it was a fantastic presentation as always, so really appreciate it.
Thank you, everyone.
The one thing that really jumped out at me, and hearing Clint speak today on the incredible opportunities that do exist going forward, as those who know us well, is Warren Buffett is key to how we think about from a valuation-driven asset allocation perspective. And one of his famous quotes, and I say Clint had mentioned another one earlier, is investing is simple, it's just not easy. And I suppose, so while it truly does sound simple, I think one of the things we sort of cover today is that it can actually be quite uncomfortable on some of the conversations that you as advice practices need to have with your clients, and it can at times not be easy. So as a result of that particular reason, which is why the Morningstar service proposition with regarding serving advice practices, and I spoke through practice optimization earlier, is really different and deep for advisors from a messaging, content, and tools perspective. So that when you actually engage with your clients, you can have these conversations with them, not just looking in the rearview mirror about where returns have come in the past, but more about looking forward. What does this mean for them and their wealth, and recommendations you need to make from a reasonable basis perspective? So in the introduction to the webinar, I refer to this really having a focus on the key themes that are impacting where returns are coming from. And I also refer to the fact that this is a client simulated experience. So hopefully that's come through strongly. And that's what I'd probably call out. For me, I'd encourage all of you to reach out to the Morningstar crew. We'd love to be able to have conversations with you in terms of taking what could be these difficult conversations with your clients who are looking at the newspapers and seeing where all the returns have come in the past, how our experience from a behavioral coaching perspective, how we can work with advice practices to make those conversations not just simple, but also much easier with your clients. And we've got a lot of content and collateral, and we can sort of engage with you on that. So with that, I'd like to thank you once again for joining us on the webinar. I hope you've got a lot of value. Please do send through your any feedback here for additional topics you might want to cover. And as I said earlier, the team that serves practices will most certainly be coming back to those specific questions that came through on certain charts, and we'll be able to talk through those with you. But thank you once again, and have a wonderful day.
Thanks, everyone.